The three main financial statements are the balance sheet, income statement, and cash flow statement. These statements provide a comprehensive view of a company's financial health, profitability, and liquidity. In this video, we will discuss the importance of each of these statements and how they are used by investors, creditors, and other stakeholders. The balance sheet is a statement that shows a company's assets, liabilities, and equity at a specific point in time. The purpose of the balance sheet is to provide an overview of a company's financial position and how it is financed. The balance sheet is divided into two parts: assets and liabilities plus equity. Assets are resources owned by the company, such as cash, inventory, and property, while liabilities are the company's financial obligations, such as loans, accounts payable, and accrued expenses. Equity represents the residual interest in the assets of the company after deducting liabilities. Investors and creditors use the balance sheet to evaluate a company's financial health and ability to meet its financial obligations. The balance sheet is also used to calculate key financial ratios, such as the debt-to-equity ratio and the current ratio, which provide insight into a company's liquidity and solvency. The income statement is a statement that shows a company's revenue, expenses, and net income over a specific period. The purpose of the income statement is to provide an overview of a company's profitability. The income statement is divided into two parts: revenue and expenses. Revenue represents the amount of money earned by the company from its operations, while expenses represent the costs incurred by the company to generate revenue. Investors and creditors use the income statement to evaluate a company's profitability and growth potential. The income statement is also used to calculate key financial ratios, such as the gross margin ratio and the net profit margin ratio, which provide insight into a company's profitability and efficiency. The cash flow statement is a statement that shows a company's cash inflows and outflows over a specific period. The purpose of the cash flow statement is to provide an overview of a company's liquidity and cash flow. The cash flow statement is divided into three parts: operating activities, investing activities, and financing activities. Operating activities represent the cash inflows and outflows from a company's core operations, while investing activities represent the cash inflows and outflows from investments in assets such as property and equipment. Financing activities represent the cash inflows and outflows from financing activities such as issuing debt and paying dividends. Investors and creditors use the cash flow statement to evaluate a company's ability to generate cash and meet its financial obligations. The cash flow statement is also used to calculate key financial ratios, such as the cash flow to debt ratio and the free cash flow ratio, which provide insight into a company's liquidity and financial strength. The three main financial statements, balance sheet, income statement, and cash flow statement, are essential tools for investors, creditors, and other stakeholders. These statements provide a comprehensive view of a company's financial health, profitability, and liquidity, and are used to make informed decisions about investing, lending, and other financial activities. By understanding the purpose and importance of these statements, investors and creditors can make informed decisions about the financial health of a company.